Assalamualaikum to Madam Zuraini. We are from Group 6 and my name is Siti Nur Isabeti Salmi. So today our group will be presenting about substance over form in Sukuk structure from an accounting perspective. So basically the Sukuk is commonly known as an Islamic bond, but unlike the conventional bonds. So Sukuk should represent ownership in real asset and involve risk sharing principle under Sharia law. So the accounting principle of substance over form means that financial transactions should be recorded according to their true economic nature rather than their legal structure. For the example, if a transaction looks like a sale but it is actually a loan, the accounting should record as a loan. So these principles creates an important issue in Sukuk accounting because many Sukuk structures provide fixed return and guarantee repayment, which makes them economically similar to conventional debt instruments. So next, I will pass to the next presenter.
Assalamualaikum. My name is Aina Sabrina. I will explain the conceptual foundation of substance over form and its relevance to Sukuk structures. Substance over form is a fundamental accounting principle which requires transactions to be recorded based on their economic substance rather than merely their legal form. This is important because the legal structure of a transaction may not always reflect its actual economic impact. By applying this principle, financial statements can provide a more faithful, transparent, and reliable representation of an entity's financial position. In conventional accounting, the concept is recognized under the IFRS conceptual framework. IFRS emphasizes that transactions should be reported according to their underlying economic reality, including the risks, rights, and benefits involved. For example, in lease accounting, accounting treatment may reflect the economic benefits received by the lessee even though legal ownership remains with the lessor. In Islamic accounting, substance over form is especially important because Islamic financial instruments such as Sukuk are structured using Sharia-compliant contracts like Ijarah, Musyarakah, Murabaha, and Wakalah. Although these contracts differ legally from conventional financing, accountants must determine whether their economic substance genuinely reflects Islamic principles such as asset ownership and risk. Substance over form is highly relevant to Sukuk structures because Sukuk are designed to represent ownership interest in underlying assets, projects, or business ventures. However, the accounting treatment of Sukuk should not be based solely on the contractual or legal structure. This is because Sukuk structures often involve complex arrangements such as special purpose vehicles, asset transfers, lease agreements, and purchase undertakings. In some cases, the legal documents may indicate ownership transfer and risk sharing, but the actual economic reality may be different. By applying the substance over form principle, financial statements can provide a faithful representation of the transaction and prevent users from being misled by legal documentation alone. This is also consistent with the objective of Islamic accounting, which emphasizes transparency, accountability, fairness, and Sharia compliance.
Assalamualaikum and good evening everyone. My name is Muhammad Farshidani bin Muhammad Rozlan. Today, I will explain the nature of Sukuk, including its definition, characteristics, and the differences between Sukuk and conventional bonds. So what is Sukuk? Sukuk are certificates of equal value representing undivided ownership shares of tangible assets, usufructs, services, or investment activity. Next one, we have characteristics of Sukuk. There are 5 main characteristics of Sukuk. First, asset of ownership. Unlike conventional bonds, Sukuk are asset-based or asset-backed. Investor own a proportionate share of a tangible asset or project. This ownership gives Sukuk holder a direct link to real economic activities, which is a key in principle Islamic finance. Second, prohibition of interest or riba. Sukuk don't involve the payment or receipt of interest. Instead, profits are generated through Sharia compliant contracts such as Ijarah, which is leasing, Musyarakah, which is partnership financing, and Murabaha, which is cost plus self-financing. This ensures that the investment complies with Islamic principles. For the third one is profit and risk sharing. Another important feature is that returns are linked to risk. Investors share in the profit generated by the underlying asset or project. Depending on the Sukuk structure, they may also bear a proportionate share of any losses. This reflects the Islamic finance principle that profit should be accompanied by risk taking. Fourth is Sharia compliance, Sukuk. Sukuk can only finance activities that are permissible under Islamic law. They cannot be used to finance industries such as gambling, alcohol, or other non-halal activities. In addition, every Sukuk issuance is usually reviewed and approved by a Sharia board to ensure compliance. And for the last one is underlying tangible assets. A Sukuk must be supported by a specific and identifiable asset or usufruct. This requirement distinguishes Sukuk from purely debt-based instruments and ensure that transactions are connected to real economic assets. So now, let's compare Sukuk with conventional bonds. First difference is ownership versus debt. Sukuk represent ownership in an underlying asset while conventional bonds represent a debt obligation. In other words, Sukuk investors are owners whereas bondholders are creditors. Second difference is Sharia compliance. The assets backing Sukuk must comply with Sharia principles. Conventional bonds do not have such restrictions and may finance any legal business activity. For the third one is asset value versus credit worthiness. The value of Sukuk is linked to the market value of the underlying asset. In contrast, bond values are mainly based on the issuer's credit worthiness and ability to repay debt. Fourth difference is variable versus fixed returns. Returns on Sukuk may vary depending on the performance of the underlying asset. However, conventional bonds generally provide fixed interest payments regardless of asset performance. The fifth one is sale of asset versus sale of debt. When Sukuk are traded in the secondary market, investors are selling ownership interest in assets. When bonds are traded, investors are essentially selling debt claims. So, in conclusion, Sukuk differs significantly from conventional bonds because they are based on asset ownership, risk sharing, and Sharia compliance. Rather than acting as lenders, Sukuk investors become partial owners of assets and earn returns through legitimate economic activity instead of interest payments. Thank you. That concludes my presentation
So
on the
next,
nature
they
of
have two important accounting standards for Sukuk, which are accounting and auditing organization for Islamic financial institution, which is AAO IFI standards, and International Financial Reporting Standard, which is IFRS standards. So for AAO IFI standard is the main international standard setting for Islamic finance. It emphasizes both Sharia compliance and economic substance. These standards state that if a sukuk structure is economically similar to a conventional bond, it should be treated as a debt. So in 2008, the Sheikh Taqi Usmani even stated that many sukuk structures were not fully Sharia compliant because they closely replicated to the conventional bonds. So next, under IFRS standard, the accounting treatment focus mainly on the economic substance. For example, the IFRS 9 classifies instruments based on their cash flow characteristics, and IAS 32 determines whether instruments should be classified as debt or equity, while IFRS 10 requires companies to consolidate special purpose vehicle, the SPV, if they control them in substance. Therefore, for both AAOIFI standard and IFRS standard emphasize substance over form. Although AAOIFI standard also includes a Sharia perspective, they have several examples for sukuk structure used in practice. First is sukuk al-ijarah, which is based on leasing. For example, the investor receive rental payments, but because the asset is repurchased at the end, so the structure often resembles as a secure loan. So second is sukuk al-murabahah, which use a cost plus sales arrangement. Since the returns are fixed from the beginning, many scholars and accountants believe it closely resembles an interest-bearing loan. Third are Suku al-Musyarakah and Suku al-Mudarabah, which are based on partnership and profit sharing concept. There are more equity-like because returns depend on the actual business performance and risk sharing. However, many users still include guarantees that make them economically similar to debt. Lastly, the Sukuk al-Wakalah is an agency-based structure where the issuers manage investment on behalf of investor. Although it is a flexible guarantee returns that can again shift the economic substance towards conventional debt. So next, I will pass to the next presenter.
My name is Muhammad Asif Ashraf bin Saha, and today I will discuss the practical challenges in applying the substance over form principle in Sukuk accounting. The first challenge is the distinction between asset-based and asset-based Sukuk. Although these two structures may appear similar, but they are very different in terms of economic substance. In an asset-based sukuk, the ownership of underlying asset is genuinely transferred to the sukuk holders. This means investors bear the actual risk and reward associated with the asset. For example, if the asset generates higher return, investor benefits, but if the asset loses its value, investor also bear the risk. Therefore, this structure closely follow the substance over form principle because the legal form and economic reality are aligned. However, in practice, most sukuk issued today are asset-based sukuk. In this arrangement, the asset is transferred to a special purpose vehicle or SPV which mainly to satisfy the Sharia requirements. Despite this transfer, the issuer often retains the economic risk and reward of the asset through additional agreements such as purchase undertakings. As a result, although the transaction appears to be asset ownership on paper, its economic substance resembles as a conventional loan. This creates difficult for accountants and auditor when determining whether the sukuk should be reported as an ownership-based investment or as a financial liability. Therefore, applying substance over form becomes a significant challenge in practice. The second challenge relates to regulatory inconsistencies and legal uncertainties. Sukuk are issued and traded internationally, but there is no single global accounting standard governing their treatment. Different jurisdictions may follow different reporting framework, particularly IFRS and AUFI standards. IFRS emphasizes economic reality and control. Therefore, if a sukuk arrangement transfers risk and obligation back to the issuer, it may be classified as a financial liability and reported similarly to conventional debt. On the other hand, our fee places greater emphasis on Sharia principles and contractual relationships. Under this approach, the same sukuk structure may be treated as a profit sharing arrangement rather than that. These differences can result in the same sukuk transaction being reported differently across countries. This situation creates what is known as jurisdictional uh, arbitrage where issuers choose location that provide more favorable accounting treatment. Another challenges that is arise during the default situation when a conventional bond defaults, the right of creditor are usually clear. However, when a sukuk defaults, uncertainty may arise regarding whether investor should be treated as a creditor or as a business partner sharing risk. These legal uncertainties makes it difficult for accountant and auditors to estimate expected credit loss, assess impairment, and provide accurate financial reporting before any actual default occurs. The final challenge is commercial pressure and the risk of window dressing. Many corporate issuers prefer that sukuk are not classified as debt. because that classification can negatively affect their financial position. For example, a higher debt to equity ratio may lower the company's credit rating and potentially breach existing on loan agreement with the banks. Because of this, management may encourage accountants to emphasize the partnership characteristic of sukuk structures, particularly musyarakah and mudarabah contracts. By focusing on these features, companies may attempt to justify off-balance sheet treatment or avoid recognizing the sukuk as a liability. This practice is often referred as uh, this practice is often referred to as a window dressing. In other words, financial statement may be structured to present a more favorable picture of the company's financial health than the actual economic reality. As a result, accountants and auditors face pressure when applying the substance over form principle. They must ensure that financial statements faithfully represent the true economic substance of the transaction rather than merely reflecting its legal form.
Okay, so Assalamualaikum. So my name is Muhammad Aiman, and right now I will be presenting about the case study. Okay, so right now let's look at the real world conflict between the form and substance. The first one is Dana Gas case. This involved 700 million Mudarabah Sukuk. In 2017, the company tried to stop paying its investor by claiming the Sukuk was no longer Sharia compliant under UAE law. So here's the detail. In form, it was profit sharing partnership, but in substance, it functioned as a debt obligation because it had a purchase undertaking that guaranteed fixed payment. A UK court eventually applied the principle of substance over form, ruling that the debt must be paid regardless of the Sharia dispute. This case warned the industry that the form can sometimes be used to hide the reality of a debt obligation. Okay, so next is the Nahil Sukuk, which is a Dubai debt crisis. So, it involved 3.5 billion Nahil Sukuk from the 2009, which is from Dubai debt crisis. This Sukuk was structured as a jar, which is a lease-based structure. In form, investors believe they held leasehold right to real estate, meaning they thought they were asset backed. Okay. However, the substance gap was that these assets were never legally registered in investor names. When the crisis hit, the sukuk behaved like unsecured debt rather than secure asset investment. This shows that without a proper legal registration, the form of owning an asset does not provide real protection in crisis. And lastly, let's look at Malaysia, a global leader in sukuk innovation. While Malaysia has a strong governance framework, many of our structure, like the musyarakah, still have bone-like features such as fixed return and capital protection. A major contemporary issue is the MACC investigations. Authorities that 85.6 million because highway sukuk fund were allegedly diverted for luxury items and gambling. This is perfect example of why substance matter. Even if the Sharia form is perfect, we need strong audits to monitor the substance of how the money is actually used. Governance alone is not enough if there is no transparency in fund usage. Okay, that's all for the case study case.
So for the implication for financial reporting, sustain over firm requires Sukuk to be reported based on their economic reality rather than legal structure. Under IFRS, some Sukuk are treated as financial liability because they economically resemble conventional debt instrument. AAOII5 places greater emphasis on Sharia structure and legal form in accounting treatment. Different accounting approaches may affect asset recognition, liability classification, profit measurement, and financial ratios. Inconsistent accounting treatment reduces comparability between Islamic financial institutions. Clear disclosures are important for ownership right, risk-sharing arrangement, underlying assets, and Sharia compliance. Proper application of substance over from improved transparency, faithful representation, investor confidence, and also credibility of Sukuk reporting globally. So, what's the future direction? Greater harmonization between IFRS and AAOIFI accounting standards is needed. A unified framework can improve consistency and comparability in Sukuk reporting. Stronger Sharia governance and independent Sharia audits may enhance credibility. And also, regulators are expected to improve disclosure and reported requirements for Sukuk technologies such as blockchain and smart contracts may improve transparency and transaction monitoring. Digitalization can strengthen accuracy and efficiency in the Sukuk financial reporting. Growth as sustainable and green Sukuk may increase ESG-related reporting requirements. Expansion of global Islamic finance market will encourage more comprehensive accounting standards and professional
So,
expertise.
one of the major challenges in Sukuk accounting is the gap between the legal form and the economic substance. Although the Sukuk are designed to comply with Islamic principle, but many structures still guarantee fixed returns and repayment of principal. This makes them economically similar to conventional debt. If the company focuses only on the legal form, the financial statement may become misleading because the investor may believe they own real asset when they are actually exposed to debt-like risk. So, in the conclusion, this report shows that substance over form is a very important principle in Sukuk accounting. Although the Sukuk are designed to comply with Sharia principle, and many current structure economically resemble conventional debt instruments. For both AAOIFIs and IFRS standard require transactions to be reported according to their true economic substance. Proper classification of sukuk can improve transparency, accountability, and investor confidence. So for the future, there should be greater alignment between AAOIFI and IFRS standard to reduce inconsistency. Insurers, regulators, auditors, and the investor should prioritize economic reality over legal form to ensure that Islamic finance remains ethical, transparent, and meaningful. So that's all from us. Thank you.